The market is brimming with opportunities, and smart investors are already positioning themselves for what could be one of the most profitable years in recent history. While many chase yesterday's winners, a select group of stocks are quietly building momentum that could deliver extraordinary returns. These companies aren't just riding trends, they're reshaping entire industries through breakthrough technology, explosive revenue growth, and dominant market positions that competitors struggle to match. Taiwan Semiconductor Manufacturing. In the race for artificial intelligence supremacy, one company holds the keys to every breakthrough. Taiwan Semiconductor Manufacturing operates at the center of the global tech revolution, manufacturing chips for virtually every major player from Apple to Nvidia. With a commanding 72% share of the foundry market, the company isn't just participating in growth, it's controlling the pipeline that makes innovation possible. The numbers tell a compelling story. Revenue surged 49% in recent quarters, with earnings projected to climb beyond 20% annually through the coming years. Analysts expect earnings per share to reach over $19 within 24 months. The company's fabrication facilities are completely sold out, creating pricing power that few businesses can claim. Customers are willing to pay premium rates just to secure production slots, a dynamic that transforms an already profitable company into a cash-generating machine. At 35 times trailing earnings, the valuation remains reasonable compared to the technology sector average of 44. The artificial intelligence build-out alone could sustain this momentum for years, making current prices look modest in retrospect. Micron Technology. Memory chips have become the forgotten hero of the artificial intelligence boom, but that oversight creates opportunity. Micron Technology manufactures the dynamic random access memory that powers data centers worldwide, and a severe shortage is pushing prices skyward. Industry forecasts show memory chip prices jumping 50 to 55% in recent quarters, with the shortage expected to continue through 2028. When supply can't meet demand, companies with production capacity reap extraordinary profits. Micron delivered 56% revenue growth in its latest quarter, crushing expectations while margins expanded dramatically. Operating margins nearly doubled from 25 to 45%. The company earned $10.46 per share in the most recent fiscal year, and conservative estimates place earnings above $19 within 2 years. At just 11 times forward earnings, the stock trades at a massive discount compared to other semiconductor companies. The memory shortage creates a rare setup where demand exceeds supply for years, not quarters. If the stock trades at 20 times forward earnings and hits $40 in earnings per share, the price could climb past $800. That's more than doubling from current levels, driven by fundamentals that are only strengthening. Palantir Technologies. Few companies in history have accelerated revenue growth from 13% to over 60% in just 9 quarters, while simultaneously expanding profitability. Palantir Technologies has accomplished exactly that, powered by its artificial intelligence platform that's becoming essential for both government agencies and commercial enterprises. The company reported 70% year-over-year revenue growth in recent quarters, with guidance suggesting acceleration continues into the new year. What separates Palantir from typical software companies is the combination of growth and profitability. The business maintains 40% net margins while revenue explodes, a feat almost unheard of in technology. Government contracts provide stability, with revenue jumping 77% in recent quarters. As defense budgets expand, commercial customers are adopting the platform rapidly through intensive bootcamp sessions that convert prospects into paying clients. The company closed $4.3 billion in total contract value during the fourth quarter, representing 138% growth. Net retention rate climbed to 134%, meaning existing customers are spending significantly more each year. Analysts forecast revenue reaching $7.2 billion in the coming year, though the company's $11.2 billion backlog suggests that estimate may be conservative. The stock trades at premium valuations, but few companies combine this level of growth with genuine profitability. For investors willing to pay for quality, Palantir represents one of the clearest artificial intelligence plays available. Meta Platforms. Wall Street has grown skeptical of Meta Platforms, worried about massive spending on artificial intelligence infrastructure without immediate payoff. That skepticism creates opportunity. The company generated 26% revenue growth in recent quarters, an impressive performance for a business of its scale. Meta is already seeing returns from artificial intelligence implementations, with higher ad conversion rates and increased time spent on its platforms. The fear around spending appears overdone when you examine the fundamentals. Meta's dominant position in social media provides a moat that competitors can't breach. Over 3 billion people use Facebook, Instagram, WhatsApp, or Messenger daily, creating an advertising platform with unmatched reach. The company's investments in artificial intelligence aren't speculation. They're building systems that make advertising more effective while keeping users engaged longer. These improvements directly translate to revenue, and Meta has the cash flow to fund development without financial stress. The market's current bearishness has pushed the stock down significantly, but the business continues performing at levels that justify much higher valuations. When sentiment shifts, and it will, the gap between perception and reality will close quickly. Meta's combination of growth, profitability, and market dominance makes it one of the most undervalued large-cap technology stocks available. First Solar. The renewable energy transition isn't slowing down, and First Solar stands at the forefront of the solar revolution. The company manufactures solar panels with a focus on utility-scale projects, and its order backlog is substantial. While policy uncertainty has created short-term volatility, the long-term trajectory remains clear. Electricity demand is surging, driven by artificial intelligence data centers, electric vehicles, and industrial reshoring. Solar energy provides the most economical way to meet this demand, positioning First Solar perfectly. What makes the company particularly attractive is its valuation. Trading at just 11 times forward earnings, First Solar looks remarkably cheap compared to other renewable energy stocks. Analysts project 20% revenue growth in both the current and following years, a pace that should support significant stock appreciation. The company's domestic manufacturing operations protect it from supply chain disruptions, while technological leadership keeps margins healthy. Recent share price performance has been strong, climbing over 40% in the past year even as competitors struggle. The combination of reasonable valuation, strong growth, and favorable industry dynamics creates a compelling setup for investors seeking exposure to clean energy without paying premium prices. Shopify. E-commerce continues expanding its share of retail spending, and Shopify provides the infrastructure that makes online selling accessible to millions of merchants. The company's platform powers stores ranging from small businesses to major brands, generating steady subscription revenue while taking a cut of transaction volume. Shopify saw explosive growth during the pandemic, experienced a pullback as that demand normalized, and has now stabilized into sustainable growth that the market is underestimating. The stock has climbed 49% year-to-date, but the rally reflects improving fundamentals rather than speculation. Shopify's light business model requires minimal capital investment while generating strong margins. The company isn't manufacturing physical goods or managing inventory. It's selling software and services with low incremental costs. This model scales beautifully as merchant count grows. Shopify is also expanding up market, targeting larger retailers who want the flexibility of its ecosystem combined with enterprise-grade features. At 85 times forward earnings, the valuation isn't cheap, but it's below the 5-year average of 98. For a company with Shopify's growth profile and market position, current prices offer reasonable entry points for long-term investors. NIO. China's electric vehicle market is the largest and most competitive in the world, making success there a powerful indicator of capability. NIO has not only survived in this environment but is thriving, with deliveries surging and new brands expanding its market reach. The company's battery swapping technology solves the charging time problem that limits electric vehicle adoption, providing a competitive advantage that traditional charging can't match. By late 2200, NIO had built over 3,000 battery swap stations, creating infrastructure that makes ownership more convenient. Vehicle deliveries are climbing sharply, with forecasts suggesting 50% growth in the current year and 47% in the following year. More importantly, vehicle margins and gross profits improved significantly in recent quarters, showing that growth is becoming profitable. NIO's newer brands, Envo and Firefly, are gaining traction and represent only 1/3 of December deliveries, indicating substantial room for expansion. The company targets 2026 as its first break-even year, a milestone that would transform investor perception. Net losses are narrowing rapidly as scale improves economics. The stock surged 45% in 2025, but trading at attractive valuations relative to growth, further appreciation seems likely. For investors seeking electric vehicle exposure beyond Tesla, NIO offers compelling growth in the world's largest automotive market, with improving financial performance that could accelerate share price gains.